great friend, not as fast afoot as he used to be in previous weeks and months. I'll talk a little bit about his background as the managing partner of a People's Company Affiliate Investment Services. Dave is an entrepreneur at heart. I'm not going to say what he is at foot, but he enjoys an extensive track record of building businesses that focus on agricultural data service technologies, creating opportunities for sustainability and soil health-focused management. He's an accomplished practitioner at creating innovative land acquisition strategies that deliver heightened investment returns. And today, he's going to be talking about farmland bulls and bears with us. Come aboard, sir.
All right, thank you, Eric. I'm pretty
to.
sure Steve was hoping I'd still be on my little cart.
Oh, he's
made some good memes on Instagram and Twitter, right?
The monogrammed one he gave you?
That's right. If I do fall, Eric, just roll me off of the back of the stage and get things ready for Kudlow. So it's great to be here. It's really an excellent meeting. I always love all of the conversation. We want to talk a little bit about what's happened in our asset class, and look at a little bit at the tailwinds, what's pushing us forward, and potentially what are some of the headwinds that are fighting us back. And we're not going to be comprehensive, right? We're going to work through a few things that we look at from a long-term farmland investment perspective as we go through this. So I'll go ahead and hop up here. Okay, so everybody's got the National Land Values report in part of the packet. Feel free to take a peek at that. This first graphic is out of that report. This is what we've seen here over the last several years, and then certainly this year on a regional basis with farmland values. Now, this data is USDA August 2021 data, with the survey sort of working in advance of that, right? So it's got a little bit of lag to it. If we look at the upper right, hopefully folks can see that, you start to get what are the values on a per state basis. Key trend, most of these regions are sort of holding through, right? They're working at their same pattern. They tend to grow at a little bit different pace based on exactly what's being produced, the characteristics of the land, and we've seen a jump in the last year, right? So when we look at the bottom right map, you can see that state by state increase over the past year. Again, with a little bit of that lag. You know, we look at Iowa as an example, just under 9%. That feels a little bit light, right? So let's look at what Iowa State came up with. This is a November 2021 survey. They do this every year. And they found that it was a 29% increase in farmland values in Iowa. We can look through all of the different counties. We can see where it increased the most. This is feeling a little bit more like what we've seen in the market. Now, we had really, really perfect alignment of sellers ready to sell and buyers being equipped to sell, right? So we saw incredible transactional volume. Context, we had over 570 auctions in Iowa in just the fourth quarter of 2021, as opposed to about 490 total auctions in 2020, right? Incredible transactional value. So when we see this, you start to ask the question, are we feeling a little bit of a bubble here? Well, let's wind this back and take a look at what really has been happening just a little bit. Starting back in 2018, Market Facilitation Program. That was the first of a number of ad hoc subsidy programs that created pretty intense value in the marketplace. Through the couple of MFPs and then into the CFAP, the Coronavirus Food Assistance Program, we're talking about $54 billion in distributions. This maps out where that money went. Pretty heavy emphasis on the feed grains and livestock regions proportionally. This really makes a difference. So I'm going to show you a couple of illustrative pictures here, right? And there's not a lot that you can take away from this. It's just sort of illustrative in the impact of this value. So the map on the left is actually looking at each state, going back to those USDA 2021 values, right? And we assume a 2% transaction rate, which is fairly consistent historically in farmland real estate. And then we look at what those ad hoc subsidies added up to by state as a percentage of that transacting value in 2021, and it's impactful, right? That's what we see. There was a lot of cash pushed into the system. This impacted the owner-operators in a very big way in order to help push us forward. All right, we also had a commodity price run. Okay, here's the big three, corn, soybeans, and wheat. Major run, the timing's kind of important, and we'll talk about that just a little bit too. Big question, you know, if you map these against the trend lines that are up there, we're not dramatically above trend line, right? We were pretty stagnant for a number of years in terms of our commodity prices. And we've gotten a little bit ahead of trend line, but not in a strange way relative to historical sort of commodity patterns. All right, so we increased the revenue. We got cash in hand, we increased the revenue. Let's look at interest rates a little bit. Everybody knows that capital has been very low cost. It's actually pretty amazing to watch this trend going all the way back to the early 80s in terms of that general downward trend. But let's put a little context behind this, right? So a 6% down to a 4% interest rate. The boxes on the right are a quick example. 160-acre, Midwest focus, 160-acre farm, $10,000 an acre. Let's say we're doing a 50% loan to value on that. So if we line it up at a 6% interest rate and look at the per acre payment versus a 4% interest rate and look at the per acre payment, we've got about $72 in additional return to land comparatively. We look at this asset as a 3 cap rate. That creates about $2,400 an acre in value. So when we stretch from that 6 down to that 4 there, that's what we add just in the cost of capital as an example to work through. Now, if we think about outside capital interest in farmland, the other asset classes, along with ours, have seen a lot of cap rate compression. Here's some data from CBRE. The upper left is multifamily cap rates. They've come down a lot, right? So if you start to think about cap rates in multifamily with the various different variabilities in that asset class compared to farmland, we're pretty competitive. And the chart on the right, it shows a whole range of different regions, and one to point out there is industrial cap rate compression down across the board and a lot of additional downward arrows. So fundamentally, highly appreciated assets in competitive asset classes with that cap rate compression, that lowering of returns, has made farmland that much more attractive along with a number of the other characteristics. Now, all of this adds up. Farm net income has been up. We saw a graph this morning with 2021 and really up over 130 billion, then back down a little bit in 2022. One of the key takeaways here that's sort of interesting is if you think back to the timing of this commodity price run in late 2020, right? A lot of these leases, the cost of land, were already in place, ready for 2021, and then we got the bump later. That created an extra buffer for owner-operators to increase that net income and have additional expendable cash for future land acquisitions. Okay, so if we put this all together, and again, this is an Iowa example where we have the most up-to-date data, and we stretch this out, the reality is we haven't shot this land value much up above trend line, right? So if you go back to 2000 and you just straight trend lined our values, we're right in the game, right? It doesn't feel like a major bubble when we look at it in this context. Okay, now I want to switch and look at some of the tailwinds, some of the things that are really helping us out and pushing value going forward. Now, a quick thanks to Dr. Bruce Sherrick at University of Illinois, the Center for Farmland Research, for helping us out with some of this data. And we've heard a lot of this today, right? Farmland is uniquely correlated with inflation. There's not a lot of question or debate about the inflationary characteristics in the economy right now. So when we put that together, and this spread graph on the right is really incredible when you see just how tightly it maps, right? Being in farmland is, as an inflation hedge, is very, very powerful, and we have certainly seen more interest from outside capital sources, investors, looking at farmland for this very reason over the past 6 to 8 months. Let's also look at the financial uncertainty. And again, this is a little bit of an outside investor focus, right, relative to the broader economy. We're really competitive on return as well as being low volatility in terms of the scale of that return. Okay, that feels good to a lot of investors when you've got uncertainty in the marketplace and where it's going to go. The chart on the right's pretty interesting. It's tracking the return at each year's start date to now. All right, so you can get those lines working on a pretty consistent pattern for each of these different equities for a number of years, and then you start to, as you get closer to present, you start to see things move a little bit. Now, what you know is over time, they're always going to level back to where they've been before. And a couple of things that you see there is some of the equities that are easy to get into feel like they've got some room to come down in this context. And farmland certainly has some room to pull itself back up to the long-term trend line. And we saw some of that happen here this year. Okay, now we've heard a lot of conversation about population, right, in the sustainability context. There's also that economic component to it too, right? Population is really easy to predict. Economic growth and a lot of these developing economies is fairly easy to predict also. And so when we start to look at that growing middle class, something we hear quite a bit, and that's the bottom two lines on the bottom left chart going up, China and India, right? That's growing fast in terms of the actual GDP and the economic output for each individual. And they also have the vast majority of people, the width of the bars in that top chart. What that ultimately takes us towards is a significantly increasing global demand for protein, right? And we're absolutely well suited within our asset class in the US to be able to play a major role in contributing. We also have another story within consumers here and in many developed countries, right? They're placing additional demands on what they want their food's characteristics to be, right? If you go back to the old school drivers of, taste and price and convenience, now we're seeing things that are more associated with experience, right? And health and wellness and various other impacts. Now, a lot of folks might say, well, that might be more of a headwind than a tailwind. What we actually see is they're willing to disproportionately pay for those characteristics, and that can create more value for us. And we spend quite a bit of time and energy trying to find those opportunities out in the marketplace to make sure we're capturing that value. Now, externalities. And Ron just gave a really great talk about carbon and how it's materializing in real financial transactions, right? And that market's still growing in a big way. When we think about farmland, we tend to think about this upper left quadrant, which is really our food, feed, fiber, fuel kind of quadrant. That's where we generate our revenue, okay? Now, the carbon marketplace has gained a lot of traction. All of these companies in the lower right have announced carbon credit programs, and that creates incredible investment and momentum to figure out the processes, to figure out the workflows, to overcome a lot of the challenges that Ron just talked about in terms of the credibility, the documentation, the measurement, et cetera. And that's going to take us forward in a big way. We also see over a longer period of time, all of these other sort of externalities are going to start to create value that are very hard to predict, right? You see that in certain areas, in certain regions, in certain circumstances now where there's high value-added outcomes. We'll start to see that broaden over time. And the scope of what this externality market's ultimately going to be is really hard to get your arms wrapped around. We believe it's going to be really significant and big. Okay, and then this digitization theme. And for me, there's kind of two threads here, right? There's a digitization theme associated just with our asset class, how we capitalize it, how we manage it, how we transact it, right? And there's also a digitization theme around how we create more value, right? How do farmers operate? How do we get more for less, right? And what we generally see in this McKinsey report, always look at it, ag's always at the bottom, all in red, right? It's pretty low on the spectrum still, but we're seeing a lot of movement in the context of our asset class in terms of making the information we need in order to more efficiently capitalize it ubiquitous across the sector, right? And that's going to ultimately result in more engaged capital and more efficiently capitalizing the asset class, and a positive thing in the long run. Okay, Now let's start to look at a few headwinds. And we picked a couple of things out that are at the forefront of our minds. It's certainly not comprehensive. They may not, and in some cases likely aren't the things that you guys are necessarily thinking about and concerned about. But we've spent a little bit of time in the last 8 months to a year trying to talk about the asset class, get it engaged with some high net worth folks and family offices that we want to work with that may not be very familiar with it. And I went out to a family office conference this fall in New York City. And it was really eye-opening and really interesting to sort of start to understand where some of this capital's at. At first, they started using this term next gens, right? Next gens. And it took me just a little bit to ultimately figure out what next gens meant. Ultimately, what this conference is the next generations of uber wealthy families. So a couple context stories, right? There was a heir in the Rockefeller fortune. And she was talking through what they're doing and how they're thinking about spending their money. And she said, well, we're just about ready to pull out from JP Morgan Chase, right? Because that's the largest fossil fuel funding bank, okay? So they were ready to pull all of their funds that JP was working with in order to make a point about them funding fossil fuels. Also had another multi-generational heir from a very wealthy investment family on the West Coast that came in, and he had sort of split from the family just a little bit. And he was talking about their conflict, right? And they had just cashed in a major asset, and they were deciding what to do with the money. And he wanted to buy a small oil company and bankrupt it. And they didn't want to do that. And when we start to work through the themes that came out of this, the making money on the investments was pretty low on the priority. It was environmental outcomes, close second social outcomes, and making money sat down here, right? The reason I say this and the reason it's important is there's a lot of really influential folks out there that are driving how capital's actually moving through the system and how a lot of these focuses are going to work going forward. So first thing I want to do is take a peek at how are we actually using our acres, right? So here's your top 10 crops with your tree and fruit and tree nuts aggregated, vegetables aggregated. I was pretty interested to see strawberries show up on this list. It made me look into it a little bit more, and the average revenue on an acre of strawberries in the US is $50,000 an acre. Did not know that. That was pretty interesting. Starting to think about what I need to do in my backyard a little bit. Now, the key takeaway here, if we look at the big commodities, corn, soybeans, wheat, and we throw the hay and haylage in there, that's really dominating the acres, like substantially dominating the acres. Okay, so let's look at this on a map. Okay, and what we're seeing here is color-coded by county. These are counties where that one crop in that color is over 50% of the acres over the last 5 years. Okay, so that crop is very clearly driving the land value in each of those counties. Okay, so let's kind of look at that. Let's pay attention to the Corn Belt and that extension of counties where corn is dominant also. Think about corn use. Okay, so when we look at the feed side and we throw in the residual from ethanol production, you're getting into about 45% plus of the crop. Now you've got 25, 26% going to ethanol. You've got your share of exports, which are going to largely be going into some of those same feed markets, and then everything else coming off of that, right? Let's put that in our back pocket for a second and thinking about how dominant those uses are and how dominant corn was across that map for setting value. Okay, another potential headwind, regulation. And we kind of think about this in 3 buckets. And these buckets, it's very inherently and explicitly, how is regulation going to limit our ability to generate revenue the way that we see it right now? So one bucket is the resource. What are the inputs? Where are we going to lack inputs? And water is absolutely the driver. You can see on that top left map, hopefully, that green dots are losses of 5,000 acres of irrigated acres. Blue dots are increases of 5,000 acres. Irrigated acres. And it comes from a combination of either regulation, limiting those irrigated acres, or the cost of getting the water is too high, right? Water is going to continue to be regulated more and more, particularly as we see some challenges coming through, and that's going to have a pretty big impact on inherent land value in the backdrop. The production side. Who's heard of Prop 12 in California and understands some of the implications? I didn't really capture all of this, but as I understand it right now, this is in effect, and they can't sell bacon produced in Iowa for the most part because we're not giving the animals enough space within their growing environments. Similarly with poultry. This is a huge market that actually is creating the need for significant capitalization in the production system to be able to meet the needs and the regulations of that market. We also see it here in the Midwest. You know, Minnesota's got some restrictions on nitrogen fall application. That has an impact. You look at this year, prepaid my anhydrous back before it ran too much. Now you're sitting there needing 32% in the spring. That's gone up threefold versus what you paid last year. These are things that have real impacts. Then on the consumption side, there's a number of things. You know, Dr. Folta talked about the GMO restrictions. Certainly here, we'll talk about this a little bit more. It's the liquid fuels segment, right? The RFS sunsetted, right? We still don't have the new RFS rules going into 2023. Who knows exactly where that's going to land, but there's a number of impacts in there. And there's state level regulations that are starting to drive clean vehicles also. So these are regulations that really impact the revenue generation, and they're out there. It's not entirely clear where they're going to show up and how much impact they're going to have, but we have to pay attention. Electric vehicles. I did not pay that much attention to Tesla in terms of how cool the cars were till about 6 months ago. You know, I kind of back to the hybrids and the Priuses and kind of didn't really engage. We were out in Washington and we were looking at an apple orchard, apple pear cherry orchard. And a gentleman that was showing us around had a Tesla Model S. And we got in that and said, wow, this is pretty nice. And he made a comment that, yeah, this is about 2.5 seconds 0 to 60. I said, really? No way. That's like motorcycle fast. And he said, okay, well, I'll show you. And hit it, poof, back in the seat. And I started looking this up, and it's 1,260 horsepower at the wheels, right? These are really cool cars. And it's created a model by which now the big three are all introducing new formats of the electric vehicles. And I now believe in the impact this is going to have. It was sort of in the background, but having experienced it, it's pretty real. So here's some Bloomberg analyses on how the electric vehicle impacts sort of play out. Here's the fuel use going down to a 2050 scenario. ETS is an economic transition scenario. So that's basically saying the market is going to let us play it out. The net zero scenario is with regulation that kind of drives it to net zero emissions in 2050. Now, we don't want to talk about, you know, electric vehicles, the batteries are not net zero, all of that stuff. It's there, it's going to have to work itself through. But the fleets that are, the picture in the upper right, the pace at which these fleets are going to grow is really incredible. And then you look at where they're projecting in 2040 the actual fleet configuration is. Internal combustion engines are half in 2040 of where they were at their peak. This is going to impact us, right? This is real, and it's going to be there. Now, I want to talk about a whole disruptive food paradigm. Has anybody seen this think tank Rethink X, their food and agriculture report, and taken a look at it? It is out there. It's crazy. I'm going to give you some highlights. There's a couple of framings that you need. Precision fermentation and food as software are the key constructs that would completely disrupt and change our food production system. Now, I can relate a little bit to the precision fermentation. I've got a daughter who has juvenile diabetes. And if you go back several decades, insulin was actually collected with every butchered pig. The pancreas was pulled out and the insulin was extracted, right? And that's how we gathered insulin to deal with diabetes. It was the most like human insulin. So what is done now is you have genetically engineered microorganisms that are fed glucose and actually excrete pure insulin. This is a precision fermentation process. It's real and it's impactful. The whole construct here is through base constituents, we're going to build the components of our food, and then these components are ultimately going to be put together in the same construct that software is put together now. So food is software. Incredibly disruptive. And here's the kicker, right? This lower left graphic, they talk about 100,000 years just living off the land as it is. Talk about 10,000 years in this first domestication of microorganisms, modern agriculture, and they say that this one's going to take 10, right? What does that ultimately mean? Well, it has pretty substantial impacts. If you believe these numbers, and I want to point out this lower right graph, right, because this actually speaks to me a little bit from Kevin Foltz's conversation earlier about messaging, right? So what they say there is it's cow beef as a percentage of total versus modern beef. That's pretty good messaging, right? Not sort of put together from a bunch of genetically engineered bugs that are creating components. It's modern beef, all right? That's a lot better than genetically engineered organism. I wish we would have thought about our messaging a little bit more previously. But what they're saying is by 2030, in this paradigm, the cow products fall 70%, effectively bankrupting the industry. Who here has the cattle disease, right? There's got to be plenty of people. I've always said that raising cattle is a terminal disease, right? It's curable either through death or bankruptcy, and sometimes bankruptcy doesn't even work. That's not good news, right? You're going to be bankrupt in 2030 here. So 60%, by 2035, 60% of the land that's currently used to feed these animals is freed up for other uses. Okay, now this is good messaging also. And then here's the one, and it ties back to this family office conversation, that conference conversation that I had earlier. This would reduce net GHG emissions from the whole system by 45% by 2030. That's the kind of outcome that drives lots and lots of interested capital from folks like we met with at that meeting. And then the net impact is a significantly negative effect on farmland values. Now, we don't see alignment of this particular vision with the world as we know it. The key takeaway here is there's going to be significant investment in these kinds of disruptive technologies, and they will ultimately have an impact. And we're seeing sort of first generations of this happen now. All right, so when we put this all together, here's some key takeaways, right? There are multiple forces working in this liquid fuels arena, right? We can see some electric vehicle impacts pushing down on ethanol production over time. We also see, and Ron had this up also, the biodiesel, the aviation fuel, the Navy, all of those upward pressures relative to creating other energy outcomes. Now, generally speaking, farmland's role in energy production is going to evolve, right? We've seen some projects where a lot of solar, so you got land, let's say eastern Colorado, western Kansas, where we've got real water issues, particularly the cost to get the water. Okay, we're seeing these projects emerge that are creating interesting energy outcomes in terms of solar and wind on massive networks, bringing renewable energy back to large cities like Denver. These things are happening. This is going to continue to evolve and create additional value. The food supply chain is going to have its own evolutions, right? We're going to see in the near term that upward pressure on animal protein, particularly in some of these developing economies. But we also should expect some disruption, right? It's going to be out there. The vision and the timelines and everything from that interesting Rethink X report, I don't think I can quite get there. There's lots of issues to sort of get your head wrapped around in that context. Now, another thing, the externalities valuation piece, that is going to become substantial, and it's going to impact our revenue on our farmland, and we need to embrace it. We definitely don't want to be pushing too hard on that. Okay, when we put these together, how are we looking at assets and regions across the country? Optionality in what we can produce creates substantial value. There's some unpredictable pieces in here. There's some pieces where we know there's going to be changes and evolutions. And being able to have optionality in our production system is really beneficial. Water's going to differentiate. That hasn't changed. That'll be consistent moving forward. Comes in the regulatory side, it comes in the actual access side. And then at the end of the day, high quality soils with consistent natural water can't be replaced, right? Ultimately, that's the maximum in optionality and value creation through the end of the system. So with that, I think I will turn it back over to Eric.
Great presentation, a lot of data. I know you've been swimming in it for years now. As we look right now and gaze into the crystal ball, 22-ish. Upbeat, optimistic, are you bull or you bear?
Yeah, so bull. We still see a lot of transactional volume, right? It's going to be down. If you think about 2021, right, you had a handful of things that essentially if you were thinking about being a seller, you became a seller, right? Prices were running. You had potential capital gains tax changes. You had at least some level of chatter on 1031 tax advantage exchanges. You had some chatter around stepped up basis, right? Now, none of those things have materialized yet, but that created an environment where if you were thinking about being a seller, you became a seller. And that really boosted the volume of transactions along with the fact that the capital was there in order to buy. We're going to see some tails on that. Yep. We anticipate we'll probably see some leveling until some of these variables sort out, right? Where is inflation really going to land? How is the interest rate response going to be? Where is farm net income really going to land? And then there will be some pushes and pulls off of that. But overall, we think it's going to be a pretty strong year.
Let me give you the 64,000 from last year as well as from this year because we're seeing rising markets still. Just sell. I just sold. I'm about to sell. Where am I going to put my money?
Yeah, we have that question a lot, right?
Are we going to go out of the Midwest into the Delta, out of the Midwest to the Pacific Northwest, from the heartland to the Great Plains? I mean...
Yeah, so if you're thinking about it in the context of one of our clients and how we want to work through, and we actually have a couple of these scenarios that are live scenarios, it comes back a little bit to your thesis, right? What are you interested in? We've got some folks that have some investment theses that actually want to engage deeper into the supply chain. They think about things like organic. They think about some of these higher end value-added food outcomes, and that tends to take appreciated farmland and chase optionality, right? And the ability to actually stack some vertical integration through the system. And, that would lend itself to Pacific Northwest. There's some things in California. There's a number of various pivots, but, at the end of the day, there's plenty of folks that have the long-term experience with good, high-quality Midwest farmland, and they know that even if it feels like it's a little expensive, I want it there.
Oh, that's fantastic. Listen, thanks for the great presentation.
Appreciate it.
Enjoyed it. Let's give Dave Muth a round of applause.